Hello, this is Linda Keith, and I am following up on a webinar, 60-minute webinar on global cash flow of tax returns when you have multiple pass-through entities in the mix. Let's see, what do we got next? High net worth individuals usually have 10 plus pass-through entities. If there is no guideline, what should we get? Well, oh my gosh, why is there no guideline? I do internal training on a regular basis to companies, and when I do, I learn their guidelines. And I'm very comfortable with the idea that we've got some guidelines, which are just guides, not hard and fast rules, and then we need to apply judgment. But one of the clients I did this year, I must admit, the guideline was so, I don't know, I'll call it mushy. You know, when do we need K1s? When do we get the full returns? Well, use your judgment. And it depends on the impact on the income. But there wasn't any percentage ownership, percentage income. There was no start gate to get us all moving in the same direction. So you need guidelines, and the guidelines need to at least get us out of the gate at the same time. Now, in the absence of guidelines, because that was your question, I regularly look at percentage ownership and I look at percentage income or impact on income. Higher control that individual has, the more they're just deciding what to take or not. The more important it is their income source, the more critical it is that I get a number that's a reasonable number. So if it's a small amount, I actually just don't care what you use. But if it's a big income, and especially if it turns out you do have both returns and you look at their K1 and then you look at what the company can afford and they're really different, I'd like to understand that difference before I move forward.